Let's talk about mortgage insurance today. What is it and why do you need it and how do you get rid of it? So we're going to talk about conventional and FHA. We're not going to talk about VA because they don't have any mortgage insurance. So let's dive into conventional. Anytime that you put 20% down or less than 20% down on a home, you have to have some form of mortgage insurance. And it's basically, the easiest way to think of it is it's just a regular insurance policy for the lender. So if you go into default and foreclose, they're gonna have to sell your house. Chances are it's gonna be a fire sale on the steps of the courthouse, and there's a good chance the lender will take a loss. So at that point, they would cash in that policy that they have. They'll get reimbursed from the mortgage insurance company, and it mitigates the loss. And so that's why they require it. If you put 20% or more down, they figure, hey, that's a big enough gap. Chances are we're not gonna, have a loss at that point. So how does it work? Well, the most common form is monthly mortgage insurance, or PMI, private mortgage insurance. And it's just a small fee that you pay each month, and you can get rid of that in the future. So usually after a couple of years have gone by, if you can prove that you have 20% equity, sometimes an appraisal is required, then they'll just get rid of it and it's gone. What other options do you have? There's also called it's called a single premium mortgage insurance, where you pay a one-time lump sum and then you never have to pay it monthly. And sometimes that can be advantageous depending on how long you'll be in the property. And the third option is lender paid mortgage insurance, where we're going to pay it for you, but we're super nice, but we're not that nice, okay? So why would we do that? Well, we're going to charge a slightly higher interest rate and then cover the mortgage insurance for you. We figure, hey, over the long haul, we're going to make our money with the higher rate. Well, this could, come back to bite you later. If you're pretty sure you're going to move within a couple of years, then that's a really good way to go, because the slightly higher rate, you're not going to pay that much in a couple of years. However, long term, you could pay much more than the mortgage insurance savings was with that higher rate. So you've got to just be careful, and every situation is case by case, and we try to give you the best advice. So that's conventional. Let's talk about FHA. So FHA is a little bit different. There's two parts of the mortgage insurance. So they're going to charge an upfront fee, which is 1.75% of the loan amount, and they're going to add that to the back of the loan and to your payoff, okay? There's also a monthly premium, just like conventional, but the difference is you can never get rid of the mortgage insurance on FHA. It's on there for the life of the loan. So you may say, well, why would I even do FHA? There's many benefits as to why you would. They're much more lenient on credit scores. They're much more lenient on debt ratios. So all things being equal, you'll probably qualify for more house with an FHA loan than you would with conventional. So there's many reasons why you would want to do FHA, but you need to know that mortgage insurance is never going away. The only way to get rid of it would be to refinance into a conventional product. So hopefully that answers questions on how mortgage insurance works. Give us a call. As I said, everything's case by case. We'll give you the best advice for your situation. All right, thanks so much. Bye-bye.